Hi everyone, so welcome to the live stream today. Very much excited for having you on the part 3 on IAS 33 earnings per share. And we want to conclude and round up on earnings per share. In case you missed the part 1, part 2, I'm going to be putting it in the description so that you can watch the part 1, the part 2 as well. So the part 3 will make sense for you to have a full knowledge of IAS 33. Then also, if you don't get it from the description, you can also check the playlist. That is Accounting Standard Series playlist, and that is the place where you can get all the list of the accounting standards that we've covered so far on the channel and or since the inception of the channel. So let's go into our discussion real quick. I welcome to the stream. I see a couple of you joining. Put in the chat box any questions that you have for me, topics that you want me to cover on the channel, and consider to give us a thumbs up on the video. That way we get more engagement on the video, and YouTube will be able to push the video so we can together reach as many students as possible. So hit the thumbs up button or the like button, smash it, let it turn blue, and then let's begin our discussions real quick. So let me open my chat box. I see a couple of chats popping in already. Put in the chat box any questions that you have for me, topics that you want us to cover from next week on the channel as we conclude today on IAS 33. Right, so let's bring up the chat. Okay, I see some chats coming in. All right. Nyansaland TV. Hi, Nyansaland. I hope you're doing well. Abdul Samed Al Hassan said, how are you doing? I'm flourishing, Abdul Hamad. Asari Ernest said, hello. Hi, Asari. Welcome to the live stream. All right. So any questions, put it in the chat box for me. And then also, when you join the stream, consider to give us a thumbs up on the video. Benjamin Aponsa Mensa. Hi, Benjamin. I hope you're doing well. Right, so let's get straight up into our discussion for the day. And let's continue with what we're going to be looking at. So, Dapa said, I'm present. Said, okay, Dapa, you are welcome to the stream. Now, so we want to look at diluted earnings per share. In case you did not watch the stream yesterday, like I said, you can get the discussion as well and look at it in that case. But we concluded on the earnings per share, diluted earnings per share, and I gave you an overview or an intro to the diluted earnings per share. So today we're going to just go into it specifically and then solve some questions in there and find out how we can actually calculate the earnings per share, taking into consideration two scenarios: when a company issues convertible loan notes, and then when a company offers share option to its employees. So that is what you need to understand there. Dapa said, I'm present. Benjamin Amponsa said, I hope you are doing well. Yes, Ben, thank you. I am doing well. Asari Ernest said, please, I'm here. I'm new here. Okay, Asari, welcome to the stream. Every day, Monday to Friday, live stream. I teach live on various subjects, on various topics. So if there are any topics that you want me to cover on the channel, you just put it in the chat box for me, or put it in the comment box if you're watching the playback, and then I'll be able to look at it and cover it on the channel. Ebenezer Sai said, good afternoon, Nhyira. Ebenezer, good afternoon. I hope you're doing well. Mohammed Kabia said, hey bro, I do admire at your delivery mood. Thank you very much, Kabai. Nancy Ogai, hello Nancy. I hope you're doing well. Right, so let's go straight up into it. Diluted earnings per share. So we said that this is a hypothetical earnings per share. Okay? Because with basic earnings per share, that tells us what exactly is happening. The basic earnings per share tells us the current position of the shareholders of the organization. How much shareholders are making right now based on the profits that the company has made for the year under consideration. So the basic earnings per share tells us the current issue under consideration. However, diluted earnings per share is a hypothetical thing that we are taking or we are bringing on board and finding out what will be the impact on the earnings per share of the shareholders should certain things happen in the future. And we boil down to the fact that there are two things that will result into the diluted earnings per share, at least for the purpose of the coverage of our syllabus. We're going to be looking at the share options, and then when the entity issues convertible loan notes. All right? Now, and we said share option is like a holding handcuff. It's an incentive package given to the management of the company for working for the entity for a given number of years. So the share options give the employees or the management of the company the rights and not the obligation to buy a number of shares into the future. So for instance, and I mentioned that you'll be dealing with this later on under IFRS 2 share-based payment. So under IFRS 2, you'll be diving deeper into this. Here we will not deal with it the way it is supposed to be dealt with. So under IFRS 2 share-based payment, you dive into that. So that option is available. Now, the question is, will they actually buy the shares in the company? We don't know. Is it time for them to buy the shares? No. But then diluted earnings per share is where we want to precondition the shareholders. We want to tell shareholders that, hey, if today you are making an earnings of say 120 cents per share, wait till the employees, the management exercise their option. Should they exercise their options, remember, your earnings will not change, but then your number of shares will go up. So since your earnings is not changing, but your number of shares is going up, then it means that your earnings per share will be coming down, possibly, and that is what we mean by what? The diluted earnings per share. I hope you are getting the idea. So are they going to buy the shares? We don't know. Is it time for them to buy? Probably no. But we want to precondition shareholders and let them know that, hey, should management exercise the rights that they have under the option given to them, this is the consequences on your earnings. Then the second thing is when the entity issues convertible loan notes. As the name suggests, convertible loan notes. And again, you'll be accounting for this better under IFRS 9 financial instruments. Now under IFRS 9, when an entity issues convertible loan notes, if you know IFRS 9 already, it has to be, it's a hybrid financial instrument or compound financial instrument. So the standard states that we must split it into the equity component and the debt component. That's not what we're going to be doing here today. You're going to be doing that separately later on, and that is IFRS 9 financial instrument. But what we want to focus on here is, hey, what is the impact of that shares or that convertible loan note on the earnings of the shareholders? So for instance, if an entity issues convertible loan notes, what will be the impact of that? Are the people going to actually convert? Probably they might not. They may not. Is it time for them to convert? It may not be time. But again, we want to precondition our shareholders. We want to let our shareholders know that, hey, there is a situation, there is a condition, there is an option available, which when it is exercised in the future, your earnings could be affected. And that is what we want to look at today in relation to the issue about diluted earnings per share. What do we do, or how do we calculate the earnings per share when a company gives a share option, and how do we calculate the earnings per share when there is a convertible loan note? So let's pick them one after the other, and then we dive a bit deeper into them. So let's look at the first one. Diluted earnings per share when the entity issues convertible loan notes. Remember, the assumption under these two is that we are assuming that the people exercise the option. So under convertible loan notes, what we are saying here is that yes, it may not yet be time for the people to convert their shares. Yes, it is not time yet, and we don't even know whether they will convert. But we were going to be assuming that they have converted the loan note into shares. For that reason, if they have converted the loan note into shares, it means that we will no longer pay the interest on the loan note. Because loan notes, we need to pay interest on it. So if we are assuming that they are converting, it means we won't pay the interest on the loan note. Remember, interest is also tax deductible. Hence, since you are not paying the interest you are supposed to pay, it means the tax benefit also you will not get. What it means then is that anytime we are dealing with earnings per share and we see convertible loan notes, as I mentioned yesterday, the profit for the year has to be adjusted, taking into consideration the interest net of tax, and then the weighted average number of equity shares definitely will also be adjusted. So under this, we say our diluted earnings per share, it's going to be profit after tax over the wins. Certainly, profit after tax, we're going to be adjusted. So it's going to be profit after tax adjusted. Then the wins, definitely you're going to adjust that, okay? Okay? You're going to be adjusting that. So how do we get an adjusted profit after tax? Yesterday we mentioned it, so let me just bring it up again. We bring the profit for the year. Alright? Then let me bring in two cash columns. We bring in the interest on the loan notes. Then we bring the tax, which is going to be applied on the loan notes usually. Then this gives us the interest net of tax. When we add that to this, this gives us the adjusted profit after tax. Does it make sense? So that is how we adjust the numerator. Okay, that's how we adjust the numerator, which is the profit for the year. Then the denominator, how do we get the outstanding shares? Again, because we are assuming that the people are converting the shares by the end of the year, it means that here also there is not going to be anything like timing ratio. In other words, we won't do any x over 12, whatever over whatever. So we just go straight. So the weighted average number of equity shares will simply be equal to the outstanding shares during the year plus the number of shares in the convertible loan notes. Simple. All right? The number of shares in the convertible loan notes. So that is what we need to understand when it comes to dealing with calculating the diluted earnings per share. And please note, anytime you have a question about diluted earnings per share, before you compute the diluted earnings per share, you need to calculate the basic earnings per share so that you can determine how the dilution is occurring, what is the percentage of dilution, and then how you can advise shareholders on what it is that they need to do in relation to that. So now that we have this, let's look at an example in here. Okay, so let's look at an example. Any questions, you put it in the chat box for me. Let me open to my slide real quick. Okay. Okay, so convertible or notes. Now, I'm reading this question from Open Tuition F7 or F Financial Reporting, their book. I'm just picking a question from there. So, Flanagan makes up its account to 31st December each year and has calculated the basic earnings per share on actual shares of 1 million. So, Flanagan, I'm just going to put the preambles down, okay? So that we can go straight up and solve the question. So, Flanagan shares outstanding, 1 million shares. Okay. Then we are told that they made an earnings of, so profit after tax, $500 million. Stay with me carefully on this one. Convertible debentures. On 31st December, Flanagan had an issue 10 million, 5% convertible loan notes. So we have 5% convertible loan notes. That's $10 million. Okay? And then look at the conversion policy. That is where the nugget is. Because remember our formula for the wings, we need to get a number of shares in convertible loan notes. So look at the conversion policy. On 31st December 20x6, the loan stock is convertible at the following date in the following terms. So on 31st December 20x6, you will get 125 shares for every every $100 bond. Then on 31st December 20x7, you will get 120 shares for every $100 loan notes. Then our tax rate in this question is 20%. The requirement is to calculate the diluted earnings per share. So the company's shares outstanding, 1 million shares. Their profit for the year, $500 million. The loan notes is a 5% loan notes, which is $10 million. And the conversion policy is in two folds. Either at 31st December 20x6, now at 120 shares for every $100 loan notes, or 20x7, 120 shares for $100 loan notes. Our tax rate is 20%. So let's see how we're going to be going through this. Let me snap this. I'm going to post it on Instagram as well, so that in case you missed it. All right. So let's go. So what did we say? Anytime we are doing diluted earnings per share, we first have to calculate the basic earnings per share. So the question we need to ask ourselves is, what is the basic earnings per share? So let's calculate that. No, I need to stop using this duster. So let's do basic earnings per share. So solution, Flanagan. So basic earnings per share. So our basic earnings per share is going to be equal to what? The part for the year over the wins. Profit for the year is 500 million over 1,000 million. So let's see what we got on that. So 500, 1,000, that's 50 cents. Am I right on that? Yes, 50 cents. Remember, we're going to multiply by 100, right? We're going to multiply by 100. So that's our basic earnings per share. But you know that as always, that's not what the examiner said we should do. We need to calculate the, how do we call it? The diluted earnings per share. So to get our diluted earnings per share, we need to adjust this profit, taking into consideration the loan notes. So let's go. Adjustment of profit. So parts for the year, 500. Now stay with me carefully on this one. We're going to bring our interest. So because they are converting, we are assuming that they are converting, we won't pay the interest again, so it will be added back to the profit. And the interest is 5% on 10 million. So 5% on $10 million, that's going to be 0.5 million in that case. Then we bring the tax effect on that, because you know that once you are no longer paying the interest, you will also get a tax benefit. So let's take the tax benefit out of that. That's 20% of 0.5 million. And that should give us, is it 0.1? I guess so. 0.5 by 0.2. Yeah, 0.1. So that we will take it out and we'll get 0.4. And this is interest net of tax. So when we add that, we'll get our profit after tax adjusted. And that's going to be $500.4 million. I hope you get it. So that is how we get our adjusted profits. That's how we get our adjusted profit. Now, having had our adjusted profit, what do we need now? The weighted average number of equity shares. Look at it. Our formula is outstanding shares plus number of shares in convertible loan notes. Now, if you look at the way the thing is being converted, we are given two periods here. We are given 20x6, and we are told that that is 125 shares for $100, and then 20x7, 120 shares for $100. If we have a scenario like this, which one do we go for? The standard says that we choose the earliest. Please take this very well. Anytime we have two periods of which the conversion can be done, you choose the one that is closer. So which one is earliest? It is the 20x6. It means that they are going to be getting 125 shares for every $100 bond. For every $100 bond. So let's rub this up. Now that we have what it is that we need. So our outstanding shares is 1,000 million plus the number of shares in conversion. You get 125. The loan stock is 10 million over $100. This is one of the places where you've got to make sure how you punch yourself out there. Because this is $10 million. That is the nominal value of the loan notes. And you will get 125 shares for every $100 loan note. For every $100 loan note. So let's punch that out. Let's see what we got. 10 million over 100 by 125. That's 12,500,000. $12,500,000. Okay, so 12.5 million. Let me just put it that way. So that 10,000 plus 12.5 will be 1/0 like this, 0.5 million. I hope you get the idea. Make sure you understand that very well. So that is now our weighted average number of equity shares. So we can now calculate the diluted earnings per share. And that's going to be 500.4 over 112.5 million. So let's punch it out and let's see what we get. So 500.4 over. Now, so look at what is happening here. On the basic level, shareholders are having 1,000 million shares, okay? But now, if these people convert, the shares will go up to 1,012.5 million, okay? But look at the effect on your earnings. It's marginal. So let's look at how the earnings per share will be. I'm getting 49.4 cents. 49.4 cents. So you see that it is bringing in dilution. Okay? it's bringing in dilution. Previously 50, now it's only 49. So that is how we deal with diluted earnings per share when there is convertible loan notes. When there is a convertible loan notes. So you put it down and let's continue. Then if you have any questions also, you know what to do. Put it in the chat box for me, and then let's continue with our discussions. Any questions for me? Okay, Mustafa Tukara, I see you. He said, how are you doing, sir? I'm doing well, and I hope you are fine. Almin Nazar said, good evening, sir. Good evening, Almin. I hope you're doing well. So any questions, put it in the chat box for me. So this is how we deal with diluted earnings per share under convertible loan notes. So let's look at the second one, that is dealing with the diluted earnings per share when there is a share option. So we've already spoken about share option, what it is, and what we get from that. So our diluted earnings per share will be equal to profit after tax over the weighted average number of equity shares. Please note that the share option has no effect on the profits. For that reason, our profit after tax, there will not be any adjustment. So, not adjusted. We're not going to be adjusting our profit here. But weights definitely to be adjusted. Okay? Because the share option will increase the number of shares in issue, but then it will not have any effect on our profit. So we will still be using the profit for the year under consideration to get our answer. Now, if the profit of the tax is not going to be adjusted, it's cool, we got it. We can deal with that. But the weighted average number of equity shares, how do we calculate it? That is a big question. So stay with me carefully as I drop the bomb for that. So how do we calculate the weighted average number of equity shares? To calculate the weighted average number of equity shares, we're going to go through three steps. Three steps to calculate the weighted average number of equity shares. So calculation of weighted average number of equity shares. You see, when share options are given, like I mentioned, it is something that we give to the to the management or the employees of the company so that they can buy shares in the company. But the deal is this: they will always buy the shares below the share price. So whatever it is, if the share price is $100, they won't buy it at $100. They'll buy it at, say, $85 or $70. So more or less like right issue. You know, with right issue, you are giving new shares to existing shareholders at a price below the current market value. With share option, you are giving shares to the employees of the company at a price below what? The current market value. So there is going to be some level of dilution. So step one, we calculate the percentage of dilution. So step one, calculate the percentage of dilution. Calculate the percentage of dilution. Now stay with me here. Well, how do we calculate the percentage of dilution? Percentage of dilution is simply equal to the share price minus the exercise price over the share price times 100. Okay, because we are working in percentages. So here the times 100 is in percentages. Okay. That is the first step. The percentage of dilution. Okay. The percentage of dilution. Then we go to the second step, and step 2 is to calculate the number of shares in the option. We calculate the number of shares in option. Stay with me carefully on that. How do we do that? So number of shares in option will be equal to the percentage of dilution in step 1 times the share option. Okay, so step 1, you calculate the percentage of dilution. Okay, if the share price is 5 and they are exercising it at 3, what is the percentage of dilution? We need to get that. Then we now come and calculate the number of shares that we are actually going to be giving to them. So to get the number of shares that we are actually going to be giving to them, hypothetically, then that is going to be what? The percentage of dilution multiplied by the share option. So now that we have the number of shares in the option, we come to step 3, and that is to calculate the win. So what will be our wins here? Our wins will simply be equal to the number of shares outstanding plus step 2, the answer we got there, number of shares in option. Okay, number of shares in option. Here also we don't do any timing ratio in here because it's just one time that is occurring at the end of the year in that case. So this is how we calculate the diluted earnings per share. Remember, our numerator is going to remain the same, nothing is going to change, but our denominator is what is going to be subject to change here. So let's look at a question with respect to this one. So I'm going to pull the scenario up here. So for the year, the company made profit of, so let's take our parts to be 1.2 million. Then let's take the outstanding shares to be 5 million. Then let's say the share price, the average share price for the year, that's 4 million. Then the share option given to the employees, let's say that is 1 million. Then the exercise price. The exercise price simply means the price at which they are going to be buying the shares. Let's say that is $3. So like I told you, the exercise price is always below the share price, okay? The requirement is to calculate the earnings per share. Okay? We calculate the earnings per share. So remember, what are we saying? Under diluted earnings per share, when there is share option, your profit is not going to change because share option has no impact, has no effect on our profit. However, your weights will be changing. And how do we get the weights figure? We go through these 3 steps. So let's look at how we can calculate the diluted earnings per share for this scenario. Let me snap this as well. Okay. So let's go. Now, as always, whatever question that we pick and we are solving diluted earnings per share, the first thing we need to do is to calculate what? The basic earnings per share. So before we even get to the details of the diluted earnings per share for this question, we need to calculate what? The basic earnings per share. So let's do that one first. So basic earnings per share. So our basic earnings per share will be, as always, profit after tax over our wins. Remember, times 100, not times 100%, but by $100 or 100 Ghana cedis or 100, because we need to get our answer in the smallest unit of the currency. So that's going to be what? 1.2 mil over 5 mil times 100. Let's see what we got. 1.2 over 5. That's like 24 cents. You can confirm that. So the basic earnings per share, if assuming this share option thing wasn't there, every shareholder currently it will be earning what? 24 cents per share. Is it a good deal? We don't know. Now, let's come to the diluted. So under diluted earnings per share, yes, still profit after tax, yes, divided by weights times 100. But this time around, the profit after tax will not be adjusted, the weights will be adjusted. So let's go through the 3 steps we illustrated a moment ago on how we calculate the weight. So step 1, we calculate the percentage of dilution. And that is going to be the share price, if you remember the formula, $4, minus the exercise price, $3, over the share price, $4 times 100. Remember, this times 100 is in percentages. This times 100 is in currency. You got to make sure that you don't make some of these things up in the exam. So I think that will be 1/4, that will be 25%. If my memory serves me right. That will be 25% for the percentage of dilution. So once we calculate the percentage of dilution, the next thing we look at is to calculate what? The number of shares in the option. Alright, what we have here, number of shares in the option. And that is going to be percentage of dilution times what? The share option. Let me even put it there. Okay, let me just do it here. Number of shares in option. And that's going to be the percentage of dilution, 25%, times the share option, which is 1 million. Okay? So that is going to give us 250,000 shares. Okay? So that's the second thing, number of shares in the option. So you calculate the percentage of dilution, that will help you to calculate the number of shares in the option. Once you have the number of shares in the option, that is going to help you to calculate your weighted average number of equity shares. And we said the weighted average number of equity shares is equal to what? The number of outstanding shares, which in the question is 5 million, plus the number of shares in the option, which you have calculated to be 250,000 shares. All right. So let's go ways. So our outstanding share is 5 million plus 0.25, and that will be 5.025 million, or 5.25 million shares. So that is our weighted average number of equity shares. Or is that it? Let me just confirm. Yep. Yes, 5.25. So now we have our weighted average number of equity shares. So what do? We calculate the diluted earnings per share. And that's going to be our profit, which is the same thing as 1.2. Divided by our shares now is 5.25 million times 100. Remember that is $100 or 100 Ghana cedis or 100 whatever currency that we're going to be using. So let's see. 1.2 divided by answer. I'm getting 22 cents, 22 points. So approximately like 23 cents. Okay, 23 cents. You can confirm that as well. So this is what is happening. So that is how we deal with diluted earnings per share when there is what? A share option. When there is a share option. So like you can see here, very simple, right? So what are we telling shareholders? We are just telling shareholders that, hey, listen, now you are making 24 cents. Wait, if the management of the company exercise their option, you may be just earning 23 cents per share. 23 cents per share. Now, I know somebody will say, oh, Nhyira, 1 cent reduction is not anything. If you own like 1 million shares, or you own like 100,000 shares, or even 1,000 shares, cents can do a lot of magics in your earnings as somebody who is dealing with that. So I see some comments coming in here. Let's look at that. Ali Baba said, Nhyira, I'm late. I salute. You are welcome, Ali Baba. Sorry for your lateness, but hey, you can always watch the playback. Benjamin said, sir, what is the difference between share price and exercise price? Okay, share price is the price at which the shares are being traded. It's like the market value of the shares. Okay, the exercise price is the price at which the option will be bought. I hope you get a difference. So the exercise price is that right now, if the employees want to buy the shares, at what price will they buy it? That is the exercise price. Then the share price is how much the shares is currently trading. And there is always that difference that they will buy the shares below how much it is trading. That is why the difference will become a profit that they make. Because remember, we said share option is an incentive we are giving to them. So how do you get your incentive? You get your incentive by buying the shares at a lower price and selling it after that, and then the difference will give you some incentive. So Benjamin, that is the difference. Let me know in the chat box if it is clearer now for you. All right. So let me know in the chat box. So when it comes to, okay, so Benjamin said, great, thanks. Okay, you are welcome, Ben. So when we talk about earnings per share, these are the things that you need to understand about earnings per share. When we talk about earnings per share, these are the things that you need to understand. So that is all about earnings per share. In summary, we've looked at the basic earnings per share, which entails three things. That is the issue at full market price, the bonus issue, remember the nuggets we added on the bonus issue yesterday, and then the rights issue. And in bonus issue and rights issue, there is going to be bonus fraction, and we said that the bonus fraction will be applied to shares outstanding prior to the rights issue. Then under diluted earnings per share, for the purpose of our exams, we are assuming two things, where an entity issues a convertible loan note, in which case it will have an impact on the profit after tax. Hence, we need to adjust the profit after tax and with the interest net of tax. Then, when a company gives a share option to its employees or management of the organization, the impact also after that. So that is what you need to understand when it comes to IAS 33 earnings per share. Now, I understand that this has been a long period, 3 sessions just to be able to complete the standard, because it's one of the critical or fundamental accounting standards, and it's one of the standards also that is very simple, sweet, straight to the point. So you got to make sure that you are able to understand each of the items in that case. So I'm going to be concluding around here today. And then God willing, Monday we will continue with our discussion. So I don't know, as of now we have a couple of topics there in other subjects that we need to be covering. There's no possible problem. What did you want? They should go forward. So we have a couple of topics there in other subjects. So you stay connected on my Instagram page, and on Monday, details of whatever we're going to be discussing will be posted on my Instagram page, and you'll be able to get the deals and follow. So thank you very much for joining the stream. It's always a pleasure coming your way. We're going to be doing this from now till you write your exams to assist you in order for you to prepare well for your examination. So you stay tuned. You stay connected. Tomorrow, I'm going to be releasing a video. I'll not be doing a live stream, but I'll be releasing a video. Then Sunday also, we're going to be releasing some videos to help you as well in other areas of the syllabus. So that is all you must understand, and I'm going to be concluding around here. For any inquiries, you can reach us on 050-114-9296, 050-114-9296. And reach us and let us know any other thing that you want us to deal with. So thank you very much. We'll see you same time on Monday as we continue. Nyan Salam TV, Abdos, Al Hassan, Ernest Asari, Benjamin, Deba, Ebenezer Sai, Mohammed Kabia, Nancy Ogao, Mustafa Tankara, Amin, Nancy, Ali Baba, and all of you guys. Thank you very much for joining the stream. It's always a pleasure coming your way. I'll catch you same time on Monday on the live stream as we continue with our discussion. But remember, tomorrow I'll be releasing a video, so you make sure you stay connected. And on Sunday also, I'll be releasing a video, so you make sure you stay connected. In case you've not subscribed to the channel, subscribe to the channel and become a VIP member, and let's build a community together. I'll see you. Enjoy your weekend and stay blessed.